Tomorrow, we have the Fed interest rate decision as well as the press conference, and I will give you my expectation for this. 10-year Treasury yields have soared 14.5 basis points since Trump was declared the 47th president of the United States, of course, president-elect until January, when he will be inaugurated. Now, today was a great day for markets. Is the Fed going to rain on our parade? Or are they going to give the markets a bit of a boost? I think we can expect a bit of a boost, but I'll break down exactly my expectations and why I believe this. Boy, is it a good time to be invested in markets. But before we get into all of that, Tom Lee, our friend, has his own take on markets, what happened today, and what's coming next. Take a listen to this clip.
Let's get right to this record-setting rally. Joining me now is Fundstrat Global Advisors Head of Research and a CNBC contributor, Tom Lee. Tom, it's great to have you on. 1,500 points for the Dow today. We haven't seen a move like that in a couple of years. Where do we go from here?
Wow. Well, I think, Morgan, today is really an example to show you that the market did not price in an election outcome. If it did, we'd be trading flat. I think it's real evidence that many investors, and this is something we could tell talking to our clients, de-risked ahead of an election because they thought there'd be a lot of social unrest, etc. And so I think money's being put to work, but in a way that reflects there's quite a lot of animal spirits in the sectors people are choosing.
The small cap, I should note, we have Qualcomm earnings out. We're going through those results. We'll bring him to you in just a moment. Mike Santoli is also with us now. So Mike, I'm going to go to you on this one, and that is the fact that we have seen this Trump trade in play today, whether it's the strengthening of the dollar against other currencies, it's the rip we've seen broadly in equities, especially those from steelmakers to banks to anything that's considered more cyclical and economically prone to stronger growth and deregulation. Bitcoin higher as well. But we've also seen some sell-offs within this market under the hood, too. Yeah. There had been a lot of speculation on whether the so-called Trump trade, as it was being defined coming into today, was going to actually pan out and play out. Your thoughts?
Well, it certainly is playing out, and it makes sense that it is, at least as an initial push. And I think on most of those fronts, it's been mostly just an additional kind of push behind some of the trends that have been stirring under the surface. Again, we've had cyclical leadership for a little while right now. The dollar has been relatively firm. Yields have been going up since the Fed cut rates, and economic surprises have been positive. Now it's just about kind of applying a little bit of that 2016 playbook and maybe sharpening it a bit when it comes to things like small caps moving, obviously banks just piling on the gains. I do think there's going to be a question as to the starting point. The starting point right now is not quite the same as it was in 2016 in terms of valuation, in terms of inflation, in terms of deficits, in terms of recent growth rates in the economy, and also arguably even in terms of investor posture. The market had been flat for 18 months before the 2016 election, and we're up 40% in the last 18 months here. I don't think animal spirits have been asleep. They've just been essentially energized that much more with this potential policy mix.
So obviously there is a lot to be excited with for broader markets. As an investor, it's a great time. Okay, there's a lot going for us. The economy is strong, as they say. I do think we're going to start getting into some weaker economic data. Just think about how many ballot counters have been employed in every county of America over the past couple of months, really. That there could be some problems when some of those jobs start to go away. But besides some near-term blips in the economy, which, yes, could be painful for stocks at some point, I think things look pretty damn good. There's a strong case to own equities right now from now into year-end with the holiday season, Trump presidency. But the Fed tomorrow. The Fed is a bit of a wild card from the market's perspective. The markets believe the Fed is a wild card. The markets believe that we're going to have a stronger economy, higher inflation, and the federal funds rate will have to stay higher, okay? 10-year Treasury yields rose 14 basis points today, up to 4.43%. Now, when 10-year Treasury yields rally this hard, into the Fed event, it's unlikely that they rally even higher. Like that's a huge move, just given, you know, Trump's the president now, right? That's kind of insane. And that's not exactly something you see happen all of the time. So from the simple standpoint, leave all the other things out of this. We've rallied a lot with yields heading into our event tomorrow with the Fed. You are more than likely going to see a drop in yields than a rise in yields because you've already priced in a lot. You've priced in, again, higher inflation, higher federal funds rate, less Fed cuts. You've priced in a stronger economy. Now, stocks did well today because you did price in a stronger economy via Trump, and that's why the Russell was up 6%, Dow was up 1,500 points, up 3.57%, S&P up 2.53%, and the NASDAQ up about 3%. You also had a big risk-off event in markets. Markets got a lot more comfortable with the current state of things, measured here in the VIX. The VIX down 20.60% today. As I really expected after the event, no matter who won, you were going to see a risk-off event for the VIX. You were going to see some shorts that were able to cover on their short positions, some puts that would be able to, you know, get sold out of. So from those standpoints, markets look very good. But the markets are a little concerned about the Fed tomorrow and the path of the federal funds rate. I can tell you with certainty, absolute certainty, there's not a lot that's guaranteed or, that's certain in markets ever. But I'll tell you with 100% certainty, the Fed does not want 10-year Treasury yields at almost 4.5%. It's making their job harder. They just cut rates 50 basis points September 18th. They were trying to accommodate the economy, not restrict it even further. And that's exactly what has happened now over the past couple of weeks. That's a problem. And I think the Fed is going to address that tomorrow. I think the Fed is obviously going to be very dovish. There's certain things the Fed could say that would drive down yields, specifically in regards to inflation. If the Fed says, and this is my opinion, something along the lines of, because they're going to be asked, okay, I should start with this. The Fed's going to be asked about Trump winning the White House, if that's going to lead to higher inflation. That's what the markets are pricing in. That's what, Jerome Powell is going to be asked that direct question, hopefully as direct as that, okay? And you know what Powell's going to say? Powell's going to say, mark my words on this, during the last Trump presidency, we had very low inflation. I don't think we should expect high inflation. I'm paraphrasing here. Something along those lines to really kind of push back at that narrative that Trump's going to cause a bunch of inflation. Now, Powell's going to hedge his bets. He's going to say if there's a lot of tariffs put on, that can be inflationary. But we didn't see inflation last time. We're probably not going to see inflation this time. And we are committed to cutting. That could cause yields to absolutely plummet. Okay? And that would be very good for markets. So that is my expectation for tomorrow. The Fed report comes out at 2 p.m. The conference is at 2:30 p.m. And that's when you're going to get the larger move in markets. And you really want to pay attention to the bond market because that's what is going to move markets either higher or lower. Now, yes, there's probably going to be a continuation of de-risking, taking off some of those hedges that were put on for a potential contested election. I think that could continue a couple of days. But what pushes this market rally even higher, what pushes the S&P past 6,000 or 600 on the SPY is going to be the Fed being dovish and yields coming down on 10-year Treasury yields. That could cause the Russell to rally even more than we've seen. Interest rate sensitive. index. The Dow would do very well. I think big tech would ultimately lag the performance of those two indexes. The S&P is going to probably do better than the NASDAQ in that situation as well. Just jumbling everything we have now, putting that together, I would expect the Dow and the Russell to outperform, S&P to do better than the NASDAQ, but you'd likely see all the indexes do well. So if you're in the NASDAQ, don't be too concerned. It's also likely going to do well. So I put the probabilities at about 90% that the Fed tries to push down, effectively does push down 10-year Treasury yields tomorrow, and that gives a boost to markets. I would be very surprised if the Fed takes the stance of they're concerned about inflation and, you know, the economy is just doing so well that they are not going to cut rates as much. Like, that's not going to happen. Okay, in my personal opinion. Obviously, I'm not a financial advisor. I'm not a financial planner. I'm not related to you. Don't take financial advice from anyone on YouTube or anyone on Google or on the internet or your family. Take it from a financial advisor if you want to, that knows your personal situation. But from my standpoint, I would be shocked, completely shocked, if the Fed does not try to push down, or again, effectively does push down 10-year Treasury yields. And again, this will likely give the markets another boost higher. Ladies and gentlemen, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. Have a safe and great rest of your day. I will see you in the next one.